I know there's a lot of concern in general about AI. I have a very different view.
Some are calling it the greatest opportunity in our lifetimes.
$900 billion. This would be more than double the company's last valuation.
Changes the internet space forever.
It is going to be wonderful.
Others are more skeptical.
And it's been a tough week for OpenAI.
The numbers that they're throwing out there aren't going to come to fruition, which is why I say they're full of shit. It's not going to happen.
But away from the hype, the underlying numbers are showing that the AI bubble is about to burst any day now, and some pretty large cracks are already beginning to appear.
There are a ton of these investments that will be dead ends.
How long you let the bubble go before there's the pricking?
In this video, we're going to go through those numbers to prove that this really is the biggest bubble in stock market history. The dot-com bubble of the late 90s and early 2000s grew out of a perfect storm. The Federal Reserve cutting interest rates after the 1998 collapse of long-term capital management, a public obsessed with the new World Wide Web, and a stock market willing to fund almost anything with .com in its name. Between January 1995 and its peak on March 10, 2000, the Nasdaq Composite rose roughly 572%, climbing from 751 points to an all-time high of 5,048. But as you'd expect, investors weren't pricing these companies on profit, or earnings, or any investing first principles for that matter. They were pricing them on narrative and on hype. At the peak, only about 14% of newly public Nasdaq 100 tech firms were actually profitable. The other 86% were losing money. Roughly 3/4 of surveyed internet companies in March 2000 had a negative cash flow. The Nasdaq's price-to-earnings ratio hit around 200, and Cisco, the era's most important infrastructure company, traded at nearly 200 times sales. It was riding a wave of euphoria, just like the one we're seeing in front of our eyes with AI. Then the hype started to fade. On March 13th, 2000, news of a Japanese recession triggered a global tech sell-off. A week later, investment newsletter Barron's ran a cover story warning that internet companies were running out of cash fast. Days after that, MicroStrategy admitted to some dodgy accounting practices and its stock fell 62% in a single session. The dominoes had begun to fall. By October 2002, the Nasdaq had fallen 78% from its peak, erasing more than $5 trillion in market value, and every gain accumulated since 1995. Pets.com, once worth over $300 million, was worth nothing within a year. More than half of all public .com companies were completely dead by 2004. Venture funding collapsed 95% from its peak, and the Nasdaq didn't reclaim its March 2000 high until April 2015, a whopping 15 years later. It's worth saying clearly, the internet itself wasn't the lie, in the same way that AI today isn't just some passing fad. E-commerce, search, and online advertising turned out to be exactly as transformative as the bulls said. The bubble wasn't about whether the technology was real, it was about businesses that were making all the noise. Too much investment capital chasing too few genuinely profitable businesses, valued on stories rather than balance sheets. Fast forward to today, and the structure looks uncomfortably familiar, but with way bigger numbers. In 2026, Amazon, Microsoft, Google, and Meta are collectively committing somewhere between $660 and $725 billion to AI infrastructure, up from about $448 billion in 2025 and just $162 billion in 2022. Goldman Sachs projects total AI capital expenditure could reach $7.6 trillion cumulatively between 2026 and 2031. As a share of United States GDP, this single year of spending now exceeds the Apollo space program and the interstate highway system, trailing only the Louisiana Purchase among major historical capital outlays. Now compare that to actual revenue. The two leading AI labs, OpenAI and Anthropic, generate a combined run rate of roughly $70 billion a year. Total global AI attributable revenue, even under generous assumptions, is estimated at $150 billion annually. Bain & Company has calculated that the industry needs to generate around $2 trillion in annual AI revenue by 2030. Just to justify the infrastructure being built today, that's some 13 times the current rates of revenue. And that's not even taking operating costs into account, because then there's the financing structure, and this is where echoes of the dot-com bubble get rather loud. Morgan Stanley analysts have mapped what they call circular financing across the AI industry. Nvidia commits $100 billion to OpenAI, and OpenAI uses a chunk of that money to buy Nvidia chips. Microsoft and Nvidia together put roughly $15 billion into Anthropic, which is contractually committed to spend around $30 billion back on Microsoft's cloud and Nvidia's hardware. AMD handed OpenAI warrants to buy AMD stock, conditional on OpenAI buying AMD chips. Oracle signed a $300 billion deal to supply compute to OpenAI's Stargate project. In each case, the same dollars get counted as growth by more than one company at once, and Wall Street has explicitly compared this to the vendor financing that inflated Dotcom revenue figures in 1999. In all honesty, it's just a bunch of companies throwing the same piles of money at each other and calling it growth. All the while, investors continue piling in because they don't want to miss the boat. The valuation multiples tell the same story. Earlier this year, Anthropic was valued at $900 billion, roughly 20 times its annualized revenue. OpenAI is reportedly preparing to go public at around $1 trillion, while losing tens of billions of dollars a year, with no path to profitability before 2030. These aren't multiples assigned to mature, profitable businesses. In March, OpenAI raised $122 billion at an $852 billion valuation, but internal projections reportedly show losses of over $20 billion for 2026, with no path to profitability before 2030. The company has also signed over $1 trillion in long-term infrastructure commitments, including more than 7 gigawatts of planned data center capacity through its Stargate project, locking in decades of spending against revenue that doesn't yet exist. It's a huge gamble. Meanwhile, ChatGPT's share of AI web traffic fell from 86.7% in January 2025 to 64.5% a year later, as Google's Gemini ate into its lead. OpenAI has confidentially filed paperwork for an IPO targeting a valuation north of $1 trillion on a business that loses money on every query it answers. Then there's SpaceX. On June 12th, 2026, SpaceX went public at $135 a share, valuing the company at $1.77 trillion, the largest IPO in history. By the end of its first trading day, shares had closed above $160, pushing the market cap past $2.1 trillion. That's an extraordinary number for a company that generated $18.7 billion in revenue last year against an operating loss of $4.2 billion, meaning public shareholders are buying into a company priced largely on the promise of future rockets and orbital data centers, not current profitability. Finally, Anthropic, the company behind the Claude chatbot, shows just how fast this can move. In March 2025, Anthropic was valued at roughly $61.5 billion. By September 2025, that was $183 billion. By February 2026, $380 billion. By May 2026, now $965 billion, roughly a 16-fold increase in just over a year. To its credit, Anthropic's fundamentals look like the strongest of the three. Annualized revenue crossed $47 billion in May 2026, and the company is reportedly nearing its first operating profit, something this guy can only dream of right now. But even on that revenue, a $965 billion valuation implies a forward multiple north of 20 times their current sales. Anthropic has also confidentially filed for its own IPO at that same $965 billion valuation, meaning, like OpenAI, it's asking public markets to accept a private market price tag set in the middle of the same funding frenzy we're describing. None of this proves AI is fake, or that these companies are worthless. The technology works, and real revenue is being generated at a pace no industry has matched before. But valuations this far ahead of profitability, financed partly through circular deals between the same handful of companies, are exactly the conditions that preceded the dot-com crash 25 years ago. Betting blindly on numbers this large, and moving this fast, has burned investors before. We saw it with the internet, we saw it with crypto, we're seeing it now with AI. As always, only invest what you can afford to lose, and do your own research. Thanks for watching, and be sure to subscribe for more videos like this one.